when you go to hire your employee, you need to set up payroll. You make a relationship with a payroll company. Well, it seems like payroll companies are not just payroll companies anymore. They are HR services, they are payroll companies, they are other employee benefits, and they have extended their services out into the retirement plan industry.
Yes.
And that sounds like a great solution. Everybody's bundling, one-stop shop. I'm just going to do all of this, and you end up purchasing a payroll services bundle that includes, oh, you have a retirement plan.
Right.
And so anytime that comes up, talk to your TPA first, because you do have to remember you already have a retirement plan, and not all retirement plans are created equal, and not all retirement plans cohabitate really easily. It doesn't
Right.
it doesn't always seem as easy as maybe the way it's described when you're asking about the bundling opportunity with the payroll company. So just make
Sure.
sure as you're
Yeah.
starting that relationship that any talk of retirement plans, make sure you relay that to your third party administrator.
And just to be clear, it's so a payroll company may suggest that you enroll in their new plan. They adopt a plan or offer you a plan to adopt, and that, or you might they might offer you a pooled employer plan or something as part of their bundled product, but you already have the most robust plan you need, which is the ROBS plan. You do not need to adopt a second plan. And if you do, you double your expense because you can't, there's no cost savings in having two plans. And you create enormous compliance issues in connection with the way the plans, as Holly put it, they don't play well together. What did you say? They don't cohabitate
Yeah.
very well. So yeah,
Exactly.
do not adopt a second plan. And if you have done that, go and talk to your TPA about it, your ROBS TPA, because they'll need to help you unwind it to save you money to correct that mistake. ROBSresource.com is a ROBS company. And let's say, for example, that I have just finished my rollover, I've funded my corporation, and I'm thinking of hiring people, W-2 employees, who will become eligible for the plan in January. Okay. So right now it's the middle of the year. In January, I'm anticipating having some people eligible for my plan because I'm going to hire them and they're going to work for me and they're going to be eligible and they're going to make some kind of employee salary deferral. And I will match that. Let's say one of the benefits I'll provide is I will make employer contributions to match their contribution. So they're going to have cash to invest in traditional investments in their plan accounts. What are the fees that I could expect to pay in that startup process?
So here's what that looks like. We do cost analysis very frequently. So what an owner would expect to add that leg of the stool on, to have proper record keeping, to be able to open up investment accounts for not only yourself as an owner, but for your employees, say they do enroll, what you can expect to pay, I'll give you a range. It's going to be somewhere between $2,000 and $3,000 a year is going to be a common expense. Now, if that seems like a lot, it's really less than what you would expect if you were to not have a ROBS transaction and you wanted to just start a 401k plan for your business that you bought traditionally. It's a little under market. So $2,000 to $3,000 is a pretty common norm to fire this up. And now the record keeper, what they get, because you're paying someone to do a service, you're going to have them keep track of money types. They're going to keep track of vesting in your account. They're going to keep track of loans and distributions. They're going to keep track of eligibility for your employees. They're going to keep track of your beneficiaries so that you're not having all this paperwork to do. They're going to give all your employees their own website so that they can log in with all sorts of financial tools and resources, check your balance, make sure that they understand their rate of return. They're going to make sure that the notices that are required to be sent out are done on a timely basis and provide those to you. Myself as an advisor is included in that range of $2,000 to $3,000. And on top of that, so now you're getting all the expertise of an advisor on top of the services of a record keeper. And again, it's somewhere going to be around that $2,000 to $3,000 a
For
year.
me to start that the traditional aspect of the plan. Okay,
Yeah.
and that's separate. Those are the service charges. That's not the employer contributions, right? So if I decide to make a profit sharing contribution or match some deferrals, those costs are separate from the administrative costs. But obviously, the administrative costs are for an enormous amount of services that are being provided that I don't have to do. Thank you very much. I'm happy to write that check when considering all the work that you would be doing in that context.
Traditionally, you have these fees that I just mentioned, this 2,000 to 3,000. You also have your annual compliance fees that you and your TPA firm, your promoter of your ROBS plan, those fees typically range between $1,500 to $2,000 a year. So
Right.
all in, you're going to be in it, let's just say about $5,000 a year to run your 401k plan.
Right.
And when we do RFPs for traditional non-ROBS 401k plans, we find that to be a little bit below market average for just about all the 401k plans in the United States do incur this type of an expense for the full operation of a 401k plan.
Okay, great.
Another important thing to remember is that your 401k plan operates like any other 401k plan in the country. One of the many intangible assets of a 401k plan is to help you understand that it's an incredible hiring tool. It's an incredible retention tool for you and your team.
Mm-hmm.
And it's part of the benefit package. We hope that you have the desired outcome of having your team retire with a dignified retirement. That's a very nice reward as a business owner to make sure that when you have employees that help grow your business, that you're treating them well. And the 401k is a tremendous benefit to make sure that they do retire with dignity, and you encourage the 401k plan participation, help them enroll, all of which we do as well, to make sure that they understand their investments, to make sure that they understand their contribution rates, to make sure that they understand the importance of saving in a 401k. As most Americans know, the 401k traditionally is about 40% of the money that they're going to retire on. So it's my goal and your goal as an owner to make sure that you utilize the 401k plan in its fullest capacity.
Wow. Oh, that's great. Thank you. Thank you, Mark.
Don't overcomplicate your organizational structure.
Okay.
As soon as a client calls and says, I'm going to start an LLC, I stop them dead in their tracks. This should be one C corporation.
Like one entity.
One entity. It has one business in it. Okay. As soon as you want to delineate organizational structures and have LLCs and subsidiaries underneath the corporation, you are increasing the level of compliance risk that you're going to get this wrong. You're going to file a paper with the wrong person on it. You're going to do a thing in the wrong way,
Right.
Whether it's with the federal government, state government, Secretary of State, insurance carriers, banks, lenders, creditors. You're going to do something wrong where your name is on something it shouldn't be.
Yeah.
And you are done.
Yeah. And it's a lot of these have like if you make a mistake, you're not allowed to say, take seat back seats. I didn't mean that, in many situations it's really hard and sometimes impossible to fix it.
We'll constantly, unfortunately, see situations where the C Corp puts money in an LLC. Done. The LLC was owned by the person, not the retirement plan.
Right. And that's a prohibited transaction.
Prohibited transaction.
Yeah, that's a bad one. Okay.
It is very easy to add complexity to the structure. It is very challenging to remove complexity. So take it one step at a time. If you're starting ROBS, that legal entity, that vessel that is created for you by the TPA, by the lawyer, the C Corp.
Right.
That's all you need. It really is. Just use it.
Right.
Fill it up with a successful business. And when you say, hey, I have my successful business in my C Corp, I want to start a second one, give us a call. There are several states where you are just going to make a mistake trying to create an LLC.
Right.
There are situations where the federal government isn't going to agree that the sole member of the LLC is the C corporation. There are going to be situations where legal service providers, discount service providers, right? Number 7,
yeah,
who just give you the standard advice,
right,
and mess it up.
right.
So don't get creative. Don't add don't be in creative or add to that invention of the ROBS.
Yeah,
It's
I know
not worth it.
some things sound very clever, like very clever strategies, but they end up being a very dangerous disservice to ROBS corporations.
Mhm.
Okay,
Yep, you don't get your tax advice off TikTok.
right, oh gosh,
This is a little more for seasoned ROBS businesses that have been around. Is they fail to actually use the retirement plan. In our Julian L memo, the IRS memo
right.
from 2012,
In 2008.
2008, that's
Yeah,
right.
the IRS had an internal memo describing some hazards that could, some sort of compliance issues that come up with ROBS. And one of them was,
People never using the plan.
yeah,
In demonstrating no intent to use the plan whatsoever.
right,
And if you can show that it's only a way to fund the business and there was never any intent to use the retirement plan, you're invalidating its purpose.
right. And that can cause tax, that puts the tax savings that you did use to fund your business, that puts that tax savings at risk, all of it, retroactively to the tune of all of your tax plus interest and penalties and understatement fee expenses, and all of this can arise from failing to use your plan. In the past, I've called this the secret plan problem, where you have used the plan for the ROBS initially and then fail to share it with your employees, notify eligible employees that they are eligible for the plan out of ignorance. I'm not saying this is some malicious intent, but a lot of ROBS owners don't realize that it's a qualified retirement plan that must be, in order to be that, must be used for retirement savings, which means accepting new contributions into the plan.
Right.
Right, contributions from rank and file employees, contributions from the company if they want to make a profit sharing contribution or something.
If you're a brand new business owner, you need to be taking the summary document of your plan, giving it to your employees, embedding it in your HR practices, ensuring that the employees acknowledge and know that there is a retirement benefit, even if it is like a non-discretionary product where if you don't put money into it, like no one can contribute.
Yeah.
Like even if it's very hands-off and no one can actually raise their hand and put money into it, you need to prove that the intent to use this plan is there. It's in your job postings, it's everywhere.
Yeah, like
Okay.
it's part of your onboarding packet, the summary plan description of the retirement plan, which has been provided to you by your third-party administrator. And it's updated from time to time. And that updated version of the document would be given to a new employee, for example, so that they're aware that there's a plan. They don't, even if they're not eligible for the plan or not eligible yet,
And
they're made aware that there is a plan and they understand why they're not eligible, for example, or when they will become eligible.
And when you talk to your TPA and you say, hey, give me the paperwork I need to give to my employees, and they say, oh, you don't have to because they're not eligible. You tell that person to kick rocks and give you the paperwork.
Yeah.
And you go and you give that to employees.
Yeah, especially the summary plan description, that's part of the ERISA requirements. And even, you're entitled to rely on your TPA to give you guidance about your plan terms. Of course, if they say, oh, you don't have anybody eligible, great, you could look it up yourself and confirm, but you should give them give the employees the SPD anyway. And that would be a terrible mistake for a TPA to pretend that that's not required.
I have seen TPAs who say, look, because no one can actually use the thing, because we checked no on everything.
Yeah.
There's no reason to care. And I say, no, that's completely wrong.
No, you need to demonstrate that there is a plan. Yeah.
So if you're a brand new entrepreneur, make sure you're checking all those HR boxes. If you're a seasoned business, as soon as your business is making money, look at your plan document and find out what features your plan has and start using those features. If there are employee deferrals allowed, start deferring your salary. Start encouraging your seasoned managers to use the thing. Get dollars into it.
Right. New contributions. Yeah.
If there are employer matches, profit sharing matches, as soon as your financials show that you're profitable, right? You have excess cash flow above your reasonable salary, right? You ended the year with more money. I don't care if it's just a few $100, like get money into the plan, use the darn thing.
Yeah, that makes sense.
And as soon as you're a profitable business and you're looking for tax breaks, people ask me, what's my write-offs in a ROBS? The plan, it's so much.
The top tax shelter.
It is.
The entire arrangement is the plan itself for new cash.
My-
You can shelter your salary, you can shelter, defer the
Mhm.
tax on part of your salary by making deferral contributions on your employees can do the same. And on profit sharing contributions, if you have a lot of cash and you want to make give a bonus to your employees for a good year, you can contribute it to the
Mhm.
plan. You get a tax deduction.
Right.
From the company gets a tax deduction for those employer contributions. And your employees are happy because they've got retirement savings tucked away that
Mhm.
they can invest.